This session, I intend to cover the stock market, the bubbles. First is we'll understand what a stock market is actually, and why it is difficult to understand the stock market. Then I'll take you through how manipulations in the stock market take place, how bubbles are formed. Stock markets actually are so difficult to understand. Nobody can understand the stock markets. Why are they interesting? Is because of the same reason, that you are not able to understand it. And they sway between bouts of greed and fear. So when people are greedy, it goes up. When people are fearful, it goes down. But how does that greed and fear actually generate? Now, first is, we have to understand that it's not a zero-sum game. I'll give you an example. Our minds are actually tuned to physics. We always believe that for every action there is a reaction. And when something happens to us without we doing anything, that's where our minds get perturbed. Now suppose all of us are holding 100 shares of Reliance each. The current market, we had bought it at about 2,000 rupees. The current market price is 2,000 rupees. Now what I do is, since everyone is holding shares, I sell my 100 shares to her. So she is holding now 200 shares. I am holding only a nil, but all of you are holding 100 each. Now the price drops to 1,500 rupees. When the price drops to 1,500 rupees, I am happy because I sold an asset which has gone down in value. However, she's bought an asset which has gone down, so she's a loser. Now, both of us, we acted on something. So reaction came to us. So it is fine that I made money, it is fine that she lost money, because she did something. She is not going to feel very bad about it, nor I am going to feel very good about it, because I made a good decision, but well, it was something, I made a decision, it happened. But then what happens to all of us who are holding 100 shares at 2,000, and when the price has gone down? You guys didn't do anything. But in spite of that, the price went down and you made a loss. Now this is what a stock market is. That you don't do anything and the stock price goes up. You don't do anything and it goes down and you get hit. Since our minds are tuned to physics, we are always thinking that something happens to us only if we do something. But in a stock market, when you don't do anything and something happens, that's how our two strong emotions of greed and fear dominate. When you don't do anything and when your portfolios are going up, you get overconfidence bias. You get over-optimism bias, because every day you want the stocks to go up. You start believing in your own abilities. You think you are smart. And then you start becoming a fund manager in your circle of competence. Similarly, when it goes down, you are again struck by fear. I didn't do anything. What's happened? Oh, this world is very unfair. I didn't do anything and my stock prices have gone down. I thought I was so rich. All of a sudden, my net worth has gone down drastically. That's how fear starts dominating. Secondly, an important thing about a stock market is you have a mobile over there. She is the owner of the mobile. So when she is the owner, so she is going to take care of the mobile. If something happens to it, she is going to be responsible for that. In a joint stock company, where a stock is listed, you have owners who are not at all responsible for the company at all. For them, it is, if a company is quoting at a good price, then they will buy that. If it is at a bad price, they'll go and sell. So you have transient investors, where the loyalty factor is absolutely lacking, except for those companies, for those managements who own the company. But otherwise, the biggest thing about the stock market is they are transient investors. With a click of a button, they are not the shareholders anymore because they have exited the company. That is one thing which creates a lot of volatility in the markets. Swing between green and fear, I have just discussed. A click changes ownership, and ultimately, what is the rule of this market is, have I made money, or am I making money, or am I cutting down my losses? Pure finance is 1 plus 1 is equal to 2. Finance plus psychology would make it anything. And that is the reason stock markets are interesting, at the same time very difficult. Since our minds are tuned to physics, if you don't do anything, greed dominates if the stock market is up. It brings overconfidence in you, over-optimism. So investors always tend to buy overpriced stocks. And when fear dominates, investors avoid underpriced stocks. This is the most important thing, because the funny thing about the stock market is that people believe that they are not taking any risk. When the markets are going up, they go on buying stocks which have become expensive, but stocks which others are buying. Similarly, when it is going down, when the stocks have to be really bought, they find the stock markets very risky. Now, when is a stock risky? When its price is going up and with others are buying, or when the stock price is going down and when nobody is buying? When is the stock risky? But still, all of you, if you individually, if you have to act, you will act very differently in the markets, because greed and fear is always overtaking you. Secondly, we human beings, we feel safe in the safety of numbers. If more people are with you doing something, you tend to join the crowd, you tend to join the herd. So here, when you see the herd doing something, it's very easy for you to go and get trapped into the herd mentality and start doing what they are doing. Now, coming back to a reason for anything, a reason for going up or a reason for going down. In 2008, when the markets tanked, the reason which was given was the oil prices have really shot up. Even today, the markets are down. The reason is there is a problem in Libya, and that's why the markets are going down, because the oil has gone up. Now, this is very typical of the economist or the analyst in the market which you see. After an event has happened, they would be always giving you excuses why it has happened. But if you want to be smart in the markets, then we have to anticipate what will happen in the markets. That will help you to make a right investment decision. Now I'll give you an example, oil and the stock markets. In 2008 also, when the oil price had touched about $130 and your index went down from 21,000 to 19,000, the same argument was there because of the oil. Now let's see some historical data. 2005 to 2007, oil prices have gone up from 40 to 100 and your index had gone up 6,000 to 20,000. 2008, when it went from 100 to 130, your markets went down to 21,000 to 15,000. So actually there is no relevance on what is happening. It is only when you want to justify an action, you always start giving an excuse for that. whenever you listen to experts, they will talk on macro factors, the economy, budget, industry trends, GDP projections, divestment. This is what the experts normally every time talk. It's always because of the hindsight bias. Experts, professionals, economists, scholars, stockbrokers, investment bankers always give you an explanation of what has happened. But if they could have told you what will happen in the future, wouldn't it be much better to have some idea of a good investment opportunity in the markets? Well, it's not that easy, but it's not that difficult also. There are certain trends which you will see in the next part of the presentation where it is quite simple to judge when something wrong is happening in the markets or when investment opportunities are about to fructify or investment opportunities are being ripened so that you could take care of them. GDP growth. What is GDP growth? Very few people will be able to make you understand that. Even your books are not able to tell you exactly what is GDP growth. Furniture is made in our country. So whatever the exports of furniture happens or whatever that it's sold in the market, it will add to your GDP growth. Against that, degradation of forest, less of monsoon, all those things is never reported anywhere. Today, what is happening in the name of consumerism, they are able to sell products to a lot of youngsters who still cannot afford them, but making them indebted over a period of time. So is consumerism good for our future generation or not? Nobody knows. You ask the future generation, they would say it's good because I can buy a whole lot of things. I can borrow and buy. But when you again borrow and buy, is it really going to improve your lifestyle? No, it's not going to improve your lifestyle because you got to be working that much more harder. You got to be working that much more harder for different sources to ultimately pay back your loans. So like they say in the US that when you are born over there till you die, because of consumerism, life is only bullshit because you are only always working, paying your loans. Today we are selling more cars than ever. The sales production has improved so much. Where is it getting us? Traffic jams, road rage, waste of fuel, time, productivity. In Mumbai city or in Bangalore or in Delhi, you go from one place to another. Distances which could be covered in 5 minutes, now they take half an hour, 45 minutes. So actually you don't know whether your GDP is growing for the good or not because you are only calculating a part of GDP. This is all book knowledge which you have been having, but unless you be practical and open up your minds to understand what is happening around you, well, you will have to really relearn what you have already learned also. And secondly, never consider that you have learned everything because every day things are changing and every day you are going to learn something new. Nobody can say that, well, I know this or I am arrived. It came, industrial production numbers came, they were at its lowest. Only when they come, then there is a reaction in the markets. Could anybody say why it was lowest or just a month back that they will be lowest? So it's really not worth reacting on the news which have come. Inflation, week ending 10 February, inflation goes down to 8%. The newspapers tell, oh, now the inflation is under control. Go to the market, find out whether the prices have gone down. There is nothing in the market which can say that inflation has gone down. Now the funny thing about how they calculate the present inflation is even the price of a bicycle is included over there. Now how many of us use a bicycle? So it really doesn't make a difference whether the bicycle prices have fallen or not. It's ultimately the food prices which is very important. Now they are trying to make a more realistic inflation figure. Let's see how realistic they make. Can anyone predict what the inflation is going to be next week? No, nobody can. So most of the time we try to predict what we cannot. Even getting into the market, you'll try to be analysts and try to predict something. Don't try to do it because you're not capable of it. You don't have the right information. You don't have the amount of information which is required. But your mental heuristic will always tell you that you are very knowledgeable. Not because of the quality of information you have, because the quantum of information you have. Today, all of us, we can have a lot of information flowing to us. But believe me, it only distracts us rather than making us much more knowledgeable or wealthier in our thoughts. Trick is, if you are going to be in the markets, never defy the markets. Respect them for whatever they are. Because whether they are irrational or not, it's not your job to go against the herd mentality. You may be the strongest person, but when a herd of weaklings come against you, you cannot stand against them. So always remember that irrationality in the markets, whatever I've told you, this is it, that you can make profits out of it, is provided you are willing to have the patience for that irrationality to bloom and then ultimately die back. Any up and down in the market, don't allow your emotions of greed and fear to take over you. Take them in equanimity, because every rise is followed by a fall and every fall is followed by a rise. If you see that, looking at your portfolio as a whole will help you to get over all these loss aversion biases. Always remember, don't be a brilliant guy, don't be an intelligent guy, but be a wise guy. Because as Peter Drucker says, is intelligence and wisdom will carry the day, but it is the wisdom that will endure. And what is wisdom? Is having self-belief, doing something by thinking whether you are doing the right thing. There's no intelligence, no brilliance in this. It's only common sense. And in the markets, if you want to be successful, there's only one thing. You have to be greedy when others are fearful, and you be fearful when others are greedy. Now, this you cannot have it every day coming to you. But there would be opportunities once every year, 2 years, 3 years. Don't miss on that, because those are the real opportunities which has made people filthy rich. Filthy rich is the word, because when nobody is buying on the road, when there is blood on the streets, you go there and buy. Saying is easier, but when you try to do it, it's going to be difficult. But always, if you take the difficult path, it'll take you ahead. Lastly, since most of you have got into the financial levels, the financial markets, understand it's with the least amount of integrity. I'm saying this with 30 years of experience. The only ruling ethos is, how do I make money from the other guy? This is the reality of the markets. Every innovation in the financial markets is against the interest of the user of that innovation. This may sound very alarming to you, but look at any innovation. Derivatives. It's a very good hedging instrument. You go to a broking house or to an investment banker, they'll help you to use that same thing as a speculative instrument. Credit card. It's a very good instrument as long as you use it only for the purpose of convenience or emergency. However, people get into debts by using credit cards. Home loans, very good. See the dotted lines. You tell me which home loan buyer has not ultimately repented for having taken the loans, because in the fine print, the fixed interest mortgages changed into floating mortgages, floating rate interest rates. So many other things, plus the charges for processing the application and everything, they're all hidden costs inside that. Any other innovation anybody can think of, and I can give you this thing, how it is against your user.
But what option does a person?
You don't have an option. It's only to understand.
Home loans especially, the ticket size.
I agree with you, but you got to, so when you are taking a home loan, you have to understand. At least first, if you know that it's a low interest regime, then you tell him you make it fixed. If you are selling it fixed, then only I'm buying for you. Look at the dotted, the small prints over there. You have to understand whether you go to a Citibank or to any Indian bank, HDFC Bank, every innovation in the capital markets are there to fool you. Because when it comes to money, the level of integrity is the least. It's a fact. You have to be smart.
So,
Yes.
so but then there is no way out actually. For some people, they have to say that home loan is against their.
No, see, I'm not telling you. If you want a home loan, you will require a home loan. But you got to understand that when you are taking a home loan, you are not really the beneficiary. That is what I'm trying to tell you. That don't go, home loans, or then don't go and tell your wife tomorrow, baby, I've got a great asset for you. That's not an asset when you have taken a loan. We have just gone through how do we understand the stock markets. Now, some of you, if I was not teaching you, you would have asked me this question, what do you think about the markets? That's why I named it stock markets and the road ahead. Because we have to understand, first is what happens in the stock market. So first I'm going to talk about how a bubble is basically formed. Now to understand how a bubble is formed, first is we have to understand what is the capital market system. What does a stock market or a capital market system, which are the participants? First is you have the corporates. Their stocks are listed over there. Then you have a stock market. So you have brokers. The stock market itself, which will go in the authorities. You'll have the regulators, SEBI would get into the authorities. Then because you have a stock market system, you have investors. Secondly, because you have investors and you have a stock market system, you have mutual funds, institutional investors, so you'll have fund managers. Because you have such a big system where a lot of people do buying, selling in stocks, which is an interesting commodity, so you'll have different types of operators. If you have fund managers who are long-term investors, then you'll have operators which try to benefit from the daily ups and down movements of the stock market. So these are all the participants who are very active in the stock markets. When a stock market is going up, when it's a bull market, everyone likes it because high stock prices who would not like. So let's understand the participants and their psychology. Let's say the regulator first. Even the regulator likes a bull market because when everything is good, our regulators are appointed by the government, so the government also feels that they are doing a good job because stock markets are up, and you all have learned that stock markets are the barometer of an economy. If the stock markets are the barometer of an economy, the stock markets are good. The politicians can always claim, well, see, the stock markets are good, that's why we are running the economy well. Regulator is happy. Government is happy. Government is always looking at the stock markets to be healthy. You know, the funny part about the market is that if you are a buyer, you are anytime better off than a seller. Why? Can anybody tell me why? Why the stock market is, I would say, tilted in favor of the buyer?
Decisions actually when selling were virtually open. The decision maker is kind of buying. You can, if you bought at a reasonably low price.
No, but even if you have sold it at a high price, why the contract? The contract is in favor of the buyer.
There is no high price. Human greed is infinite.
Whatever that is. But why in the stock market? They think a buyer is much better off than a seller.
Because of private enterprise, we are the shares, we can hold it till whenever we like. Whereas the seller has lost the opportunity. If it goes down from there, he can still feel good about the price having gone down. If it goes higher, the price, then he would have lost the opportunity. The buyer.
No, I'm talking about a buyer and a seller not even taking delivery. I'm talking about a buyer and a seller not even taking delivery. Why is it in favor of the buyer and the
So
seller?
the buyer is saying a price, so which will reflect on the wealth of all the people who hold the share. So without doing anything, actually their notional wealth goes up. That's why probably the market is skewed towards that.
That may be one point. But from an investor point of view, from a market point of view, they think, what is that vital thing vis-a-vis a buyer and a seller? Why a buyer is more informed, a seller is taking a bigger risk? Why is it that? Anyway, the problem is, if you buy a stock, and if you don't have the money, if you want the money to take the delivery, a stock price is quoting at about 30 rupees. When you buy a stock, you know that it can go only down to 0. So, only 30 rupees you can lose. If you have bought a stock not having money, you have so many people from whom you can take the money and take the delivery of the stock. Now, consider if you are a seller. First is if you sell a stock at 30 rupees, do you exactly know what the price will be? You don't know your losses. Because it can go to 300, 3,000, 30,000. You don't know your losses. Secondly, if you have to give delivery of that stock, what is your ability to borrow that and give that delivery? Only you have to go to the people who have the stock. Now this is the biggest difference. If you can borrow money from everyone, but you can borrow money only from those shareholders who have the stock. Stock, when you buy, you know what the loss are. But when you sell, sky is the limit. That is the reason that never short market, never short sell is the most dangerous, most stupid thing to do. Because if you sell my house, then you'll have to come only to me to borrow that house and give the delivery, and then I can ask for any price. Yes.
And why did you not short sell? Please explain better.
Well, when you short sell a stock, suppose a stock is quoting 30 rupees, you short sell, it can go up to 100, 300, 500, 1000. So it's a very big risk you are taking. Secondly, if you have to borrow, if you have short sell, if you have to deliver in the market, if you have to borrow, where can you borrow from? Only from those people who have that stock. And when you are a buyer of shares, you require money. Money you can borrow from anybody. So your universe of borrowing is much more. Secondly, when you buy a stock, you know how much you can lose. When you short sell a stock, you don't know how much you can lose. Stock exchanges, what is their psychology? They also want stock markets to go up, because if they go up, the brokers offices trade more, they get more this thing by way of stock exchange charges, more companies get listed, and ultimately the kitty goes on going up. Banks, because when the markets are up, the banks are able to lend against stock. Different types of credits they are able to give to the clients. So the banks also. The media, 24/7, they will be able to have their channels full, being properly. Different analysts coming on the road, on the shows, talking about about stocks. That also makes it important for them, because it's business. Companies, which company management would not like its own stocks going up? Mutual funds, Stock market is up, investors are irrational, they invest madly into mutual funds because that's where the money ultimately goes. Brokers, good business, good opportunities for arbitrage, more clients come in. Investors, without doing anything, stock market prices going up, they would love it. Operators, companies approach operators, "Hey, mera stock nahi chalta hai. Can you do something about it?" Now, this presentation is going to be about that. Now, if you have to understand the markets, we have to understand the investor biases. We have tried to do the participant psychology and understand the systems and system thinking. Now, biases, all we have already covered. These are the basic heuristics which will come into play. So when I take you through the bubble exercise, you will realize, and there could be more biases which we can add also. But understanding how a system works and how system thinking works is very crucial to understanding of the stock markets. What is a system? A system is something that maintains its existence and functions as a whole through the interaction of its various parts. A human body, our body, is a perfect example of a system. It consists of different parts and organs, each acting separately and yet all working together. You getting it fine? And each affecting the others. The heart cannot function without blood supply. And this heart is the same one which to the various parts of the body. So this is how a system is working. Now, an eye can see and a feet can move. It's because they are a part of a system. There are systems actually all around us. And even we have systems within the systems. Everything works as a system. Our body, the financial markets, the banking sector, the businesses, this institution, they all work as a system. Now what is system thinking? System thinking is actually looking at the whole, the different parts and the interconnection between the different parts. However, if these parts are not connected and not a part of the system, what will we have? We'll just have a heap of parts. We cannot have anything else. A dead body, this thing has legs this way, but it is only a heap of certain parts of a dead body. So, system thinking is basically thinking in circles, or it is thinking in loops rather than in straight lines. Normally what we think is, okay, this is a straight line, but this is thinking in loops, one by one by one by, there's a loop which is being formed, a system comes, a reinforcing loop comes, and then a feedback loop comes. So it goes out in circles. The parts of a system are all connected directly or indirectly. Therefore, the effect of this will ripple out in turn to affect the original part. The original then responds to the new influence. The influence that comes back to the original in a modified way is basically a feedback loop. You call it a feedback loop. Now, hunger is a very good example of a feedback loop. When you realize that you are hungry, you feel like having food. So you start eating. As you eat, you go on feeling less and less hungry. So you start eating less and less. You keep on eating till your hunger is satisfied, and then you stop eating. So what has happened? There was a loop which was working. You ate a little, then you were more hungry, so then again you ate, again you're hungry. Now, your hunger was influenced by the food you ate, and in turn, the amount of food you are influenced your hunger also. If you had more food, then your hunger became less. It actually looks like one action, that you ate and your hunger went away. But actually, it is a loop. It would be only one action if before you are hungry, You know exactly what to eat. I'll have 2 chapatis, so much rice, so much dal, and I'll be set. But it never happens that way. So, this example is because you have to understand what actually a loop is. How things go round and round, and every loop, every feedback loop, there are 2 types of loops. This thing anyway is coming. When 2 parts are connected, the influence can go both ways, you know. If both are connected, it can go both ways. Like in a telephone line, if you can dial a friend, he can also dial you. Feedback is actually the output of a system re-entering as its input, or the return of information to influence the next step. I don't know, everyone is clear or anybody is not getting it, because the stock market system is going to be based on this system thinking. Feedback is actually fundamental to any system. Without feedback, there cannot be any system. We shall see that very often the most critical point of leverage in any system are actually the beliefs, the sentiments of the people, because it is the belief that sustains the system, which now we are talking about the stock market system. It's the belief. Just now everyone is believing that GDP growth will be good, our economy will go well. So it is the belief which is sustaining the system. Stock market is a classic example of such system, and the behavior of its various participants and the beliefs from time to time make the stock markets very interesting. Feedback is fundamental in systems. No feedback, no system. The feedback loop is the output of a system entering again as its input, or the return of information to influence the next step. We have 2 types of feedbacks. One is reinforcing, which it reinforces and takes the thrust in the direction of what it is going. Then a balancing feedback is which reverses the trend it is going. However, all systems have balancing loops, since the goal has to be to remain stable. Okay. Now this is how exactly it works in the stock markets. Stock price is very crucial for everyone. All the participants, for them the stock price is very crucial. More so ever, it is very crucial for the corporate. So what happens in the market? In a typical situation, the management of a corporate goes to an operator. Operators are specialists who play in the markets, who rig up the markets and create artificial markets for certain stocks. Now, this is how it works. A corporate says to an operator that my stock is only languishing at 10 rupees. The markets are going up. Can you help me to take the markets up? To take my stock markets up, stock price up. Operator, yes, I can do that. Actually, how can it be done is only if more people buy it. That's the only way ever. But there are ways in the markets, which is a system, how you can abuse a system and really make artificial markets for certain stocks. So the operator goes to the corporate and tells him, well, you give me an X amount of shares if you want me to rig up those prices, and give me X amount of money, because I need sometimes to give delivery of the stock in the market. I have to sometimes take delivery, so I require the money. So he has both the ingredients with him. Stock is not supposed to be paid back to the, because He says to the corporate, you give me an X amount of stock at an X price, I'll pay you a price for this. Because now he's going to play in the markets. So for him, this is going to be his initial investment. The corporate thinks, well, let me give him the stock because he will be able to take the stock price up. So if I give him an X amount, I don't mind, but all the stock prices will go up. So the corporate believes that this guy, if he's going to make money, he'll make much more money than him. That's how both of them get together. Now, what would be the idea? The first idea would be to create a good reinforcing loop. So, the operator has a band of brokers. From one broker to another broker, they go on selling certain, one broker A will buy that stock, sell it to broker 2. Broker 2 will sell it to broker 3. And they all are interlinked. They are all in the sale. But when it goes into the stock market system, you find 100. So there is a turnover of about 600, 700 shares, which just go on. So the velocity of the trading goes on increasing. And people think, oh, there is something happening in the stock. How many times have you heard or read, oh, there was some movement in the stock. This is how the initial movement is created. This operator owns this band of brokers. They go into circular trading. If you know, if SEBI has banned about 22 broking firms, they were caught doing these things. The first reinforcing loop is put into place, and this is the starting of a bubble. When the stock prices start moving up, there's an availability heuristic in the market. Oh, because the newspapers start reporting that this stock price is moving, there's something happening over there. Management also starts planting in stories. So if you've got a big order or some patent, they think we have bought this acquisition, all those sort of insider news start coming into the market. So all the insiders in the company circle, they know, oh, I'm working in this company, this stock is going up, I didn't know about it. So they all start entering the market. Stock starts rising. Now this stock has never risen. It has been always languishing. So a saliency effect takes place. All of a sudden something has happened to that stock. When a saliency effect takes place, they start talking about it because it is a one-off event. It had never happened. So it is, it is the mystery which is going to unfold now. And the broking firms start sending out reports to their clients, to the different mutual funds. Mutual funds something good in the offering. Mutual funds are always looking at ways to really make money for their investors. So they are always looking at certain opportunities to make up. So when all these reports are floating in the market, the mutual funds start entering. Now when the mutual funds start entering, there is credibility given to the stock. Now these mutual funds could be entering because they have been paid by the operator that you buy this stock, I'll pay you an X amount per share. Well, that happens in the markets. That's why it's not new that in an IPO also they say I'll give you 30 rupees per share and you apply from your mutual fund X amount of shares, or these shares I'll give you an X amount. So with all those things, the mutual funds also start entering the markets, giving credibility. Now this is the time where the main operator or the early entrants, slowly they start exiting. Now there are two reasons for exiting. One is to take on the profits. Another is to give liquidity to the market. Because if there is not enough liquidity in the market, the bubble cannot go. Because that amount of stocks should have a very good velocity of moving. So when people put in their orders, I want 10,000 shares. If he doesn't get 10,000 shares, then they will say, market mein liquidity nahi hai, don't get into this stock, we want milta hi nahi hai. So when we want to sell, we will not be able to sell. That's a very big psychological heuristic for the investors. That's why slowly, more and more shares come into the market. And when more shares come, what happens? The reinforcing loop this thing gets a very good kick, because more and more people start entering, because more and more people's appetite for stocks, this thing is again this thing fulfilled. Then the retail investors and all this thing all start entering the markets. Retail investors will enter at 14 rupees, sell it at 16 rupees. But when thousands of people do like this and 2 rupees profit, that availability heuristic spreads in the market. Everyone then talks about that stock. Everyone thinks, "Arey, ye best stock hai." You will talk about a stock only when you have made money in it. Now whether it is 1 rupee, 2 rupees or 10 rupees. And you start becoming a salesman of that stock because you have made money in that stock. Then if you have bought at 12, sold it at 14, if it goes to 20, you believe this stock has been lucky for you, so you go and buy at 20 also. So the same people who are sellers also turn buyers when they see that on reflexivity the stock is just going one way up and up. Now this just goes on going up and up, and the bubble ultimately becomes for the real. Now when the stock is rising, suppose the stock has gone up to 50, 60, 70 rupees. All the system participants are happy. Now, even if you know there's a circular trading, if all these things are there, nobody wants to play the whistle. Now, this is somewhat like a predictable surprise when such things are happening in the market. Now, predictable surprise, like you know something is going to happen, but you don't want to take action. It's like if you are a chain smoker. The day you get your lung cancer, it was a predictable surprise. 9/11 was also a predictable surprise. US government knew that the hatred towards USA was increasing. There were so many threat mails. They had tried to bomb the World Trade Center and not been very successful. All these things were there. But if at that point of time, had they taken an action of increasing the security at the airports, Americans were so used to free traveling that there would have been a reward. So sometimes if it ain't broken, don't fix it. That's how we always, this thing always relate to matters. Similar is the case over here. All the participants, they know something is dangerous, the government knows it, but then you will say, well, it's going on, let it go on. That's human psychology. Now, the stock has got so much of publicity that the banks and the private financiers also are agreeing to lend against that stock. So now if an HDFC bank or a Citibank tells you that they have included this stock in the list of lending, again it adds extra credibility. Okay, I can buy this, I can put that and I can get money on that. So again the reinforcing loop, this thing enters a much more vicious phase. More people start entering, now the greed starts getting. Because those people who exited, they see the stock price rising, they again start entering. Again reinforcing loop is again strengthened. It becomes a stock market favorite because anytime you open your CNBC, they start with, oh, this stock has risen so much, or it just gone down, but well, in the late trading, it had gone up. So when it becomes a stock market favorite, everyone talks about it. Again, it adds to the herd mentality because everyone starts buying it. And when such a thing arises, IPOs enter in that segment. Now here I am talking about a stock, but suppose if this was a real estate stock, then the same management, like what we saw, that Reliance Energy was there with a person, but then again he comes out with a Reliance Power because he can now again attract money from the market. Here the game is, if investors are irrational, how do I take their money? So those who are left out, they feel they were fools, but when they enter, actually they prove that they are bigger fools, because now it's already gone up and they feel that we'll be left. It's the greater fool theory. Then you have media, CNBC reports, representative heuristic. What it does, it takes all other stocks in that same segment also up. So then this bubble looks for real. No, it's not only this stock, all others are rising, but it is because of different heuristics that it is rising. Now actually balancing loop is awaited. between a cause and an effect, there is time lag which nobody can know. Such bull markets can go on for 1 year, 2 years, 4 years, 5 years. You don't know when the balancing loop can come. But it has to come. And the severity of the balancing loop will be directly proportional to the reinforcing loop. Now, how does a bubble get pricked? Nobody knows the time. But there comes a time where the feedback loop comes, people start exiting, the fancy ends, there are different news coming in the market regarding the company, there have been leaks in the management or the operator, a fight between the operator and the management, and you see a different, that the stock takes a beating, and for a continuous period of 2-3 days, when it goes down, then what happens is, slowly the fear sets in. Because a lot of people, they think would have bought at the high price, and then when the trend is not going as it was going always, there would be a few cheaters rallies. Now what are a cheaters rallies? Is stock will never go down like this. It will go down, and then it goes down. Similarly, it goes up. Now these are different type of cheaters rallies. When it is going down, people feel, oh, now it's become a great value, so let's buy that stock. So in that cheaters rallies, a lot of people come and give a good cushioning to the stock not going down perpendicular. But what does that cheaters rally do? It only entraps more and more people. Because if you have seen a rate of 50, and then when it is 35, oh, now it cannot go down because everything is clear. And everyone enters at 35. So on the contrary, you start entering at higher rates. And then slowly, once it starts going down, then the fear sets in. Then the crisis of confidence comes. Now the balancing loop is at work. Because all those who were buying, now they start slamming. Because the system has to become stable. System has to be, why the system has to be stable? Because something wrong has happened. A stock which was not worth 10 rupees has gone up to 50 rupees. So now that balancing, if the system has to be stable, some people will make money, some people will lose money. But ultimately it has to be balanced. So when the balancing loop is at work, you have again confusion in the markets. Why? Because there will be one set of people talking good about that stock, one set of people talking bad. Now in this confusion, cheaters rallies also flourish. And some of you, if you are holding stocks, first is you have an anchoring effect, you cannot sell because you have bought it at a higher rate. So then you have a decision paralysis, what to do? Well, don't worry, I'm a long-term investor. That would be the reason everyone would give himself, no, as it is, I never trade in stock, but he is not trading in stock, he has become a long-term investor because by default, because he is already making losses, he doesn't know what to do. Slowly, again, once the balancing book is working, the stocks ultimately go down, everything goes down, stock prices fall. It just goes round and round. It takes a few weeks, in certain cases a few months. Well, stock price, something wrong with the stock markets. The government would ask, find the culprit. SEBI, all of a sudden, comes out with certain regulations, and again a crisis of confidence is created. Because people are now again confused. Financiers, you know the bankers, they will only lend you an umbrella when it is not raining. So when there is a problem, they will tell you, no, we don't want this stock in our list. You please pay off this money, otherwise we are selling the list. People cannot pay the money, so they go on selling. Now that adds to the downward spiral of the stocks. Negative media news start coming in. And then you have different types of scams also surfacing. Because in such a situation, they think you will have where did the people get money? Because in a bull market, for you to rig up the prices, you require money. So all the scams which you have seen are only because of money, and only banks are involved. So then banks get involved and certain scams come in, or you have fights between brokers who are doing margin trading and the clients. I told you not to sell because I was going to give you the check. The broker says, no, what to do? The stock market sold my shares because he has to have some balance with the stock exchange authorities. So they sell off that. So then you have different types of fights in the market, which is very good because the feedback loop is getting again into play. Then all of a sudden the herd mentality also develops. Because when everything is going down, then everyone wants to sell, mera bech, koi bhi bhav mein tu bech, but let me get out of it. One stock which was always a favorite now becomes nobody wants to hear. There is fear at its peak. Now I explained you with the operator and this about a stock. But this is also true of the stock market bubble which we saw during the Harshad Mehta boom. What was that bubble? Harshad Mehta boom was during a basket of stocks which were going up, and along with the representative bias everything was going up. And the scam, the money came from the bank. Similarly, the IT boom, the Ketan Parekh stock, K10 stocks, IT boom, it was actually the world over, but here also it was the K10 stocks, along with that the representative bias and all that technology stocks. And where did the money come? The money came from different Kolkata broker finances and all, and a few of the banks. So it has always to be the money which gets in over there. In a bull market, scams arise because of money, and in a bear market, scam is always on information. That is when inside information is leaked. Like the IT boom, the bust. It was the past president Anand Rathi talking on the phone. Okay, who's selling this broker? Now he was trying to extract some information. That information leaked out, and that showed the weakness of a certain band of bull operators, and the bears then hammered upon them, and ultimately the markets went down. Now this is so important in this because the operators and all, they are able to really impress on the imagination of the crowds. And they know exactly what to put in the markets, what to put in the newspapers, and the investors fall for the bait. Bull market is always because of source of money, bear market source of information. Okay, so now how do we see the stock markets today? Consider it as a case study. All available information is positive. Media reports is positive. Stocks show an upward trend. FIs are pouring in money. IPOs have started to getting oversubscribed. All market participants overconfident. Optimism prevails all around. Well, all this I had done about in the month of October, November. That's why today things are not as they are. But at that point also I thought it was definitely not a bubble. Feedback loop was my only prediction. Can set in. Adverse global news, slowdown, corporates profits fall, FIs inflow stop, internal problems, problems with the neighbor, scams surface, interest rates go up, sentiment changes. Believe me, this I had done in October, November, and exactly it has happened. Now, I don't say I'm a genius. I'm telling you. But I want you guys to understand that always think about a feedback loop which has to come. I only thought of this as a feedback loop. Now, when I wrote about scams and all, it was a predictable surprise. It had to happen because as it is we are seeing certain scams being unearthed. And I thought, well, if things are changing, that could come. Secondly, corporate profits falling. They had been rising for the last 2 years. So it did not require a genius to say that the law of averages will ultimately come in and profits will fall. Slowdown. If you have been running continuously for 4 hours, 4 hours and 5 minutes, you have to slow down. You can't have the same speed. Adverse global news was evident because in 2008, so much liquidity was put in the markets that inflation had to raise its rear head. And inflation is rising for the simple reason there was excess liquidity created in the markets. And when there is excess liquidity, what happens? There is an asset inflation. And when there is an asset inflation of this sort, what happens? People become poorer even by having money, because your purchasing power is going down and down. Internal problems, the way things are, the thing. Even I can predict we are going to have internal problems in the next 6 to 12 months. Interest rates going up. Anybody could say, because they were so low, inflation was rising, interest rates had to go up. So this, what I've done was not of any genius. It's only keeping your mind open, keeping your ears open, thinking that a system has to be stable. And if it has to be stable, things are going this way, where would it correct? And sentiment ultimately has changed. This I have already discussed with this view. The road ahead, I would say, be fearful as others are turning greedy. That was what I told them. Don't try to predict and time the markets. Avoid overpriced IPOs. Because that time all these real estate IPOs were going to come in the market. Ride your winners and sell your losers. If you have good winners, ride them. Don't chase fancies of the market. Values will be available in neglected sector. Holding cash may not be a bad idea. Bottom of stock picking may be tiring but rewarding in the long run.